Planning for retirement is one of the most important financial goals you will face in your lifetime. Understanding how 401k works is essential to building a secure future. A 401k is a retirement savings plan offered by employers to help employees save for their later years. Named after a section of the U.S. Internal Revenue Code, this plan allows you to contribute a portion of your paycheck to an investment account before taxes are deducted, giving you immediate tax savings and the ability to grow your wealth over time. One of the key advantages of a 401k is that many employers offer a matching contribution. This means that for every dollar you contribute up to a certain percentage of your salary, your employer will contribute an additional amount. For example, if your employer matches up to 5% of your salary and you contribute that amount, they will add an equivalent 5% to your account. This is essentially free money and represents an immediate return on your investment, making it a crucial aspect of any retirement savings strategy. The combination of tax advantages, employer contributions, and compound growth makes the 401k one of the most effective tools for building a comfortable retirement. Relying on Social Security alone is no longer a viable option for most people. The cost of living continues to rise, and longer lifespans mean that retirees need more savings to sustain their lifestyles. Additionally, uncertainty about the future of Social Security benefits adds another layer of risk. By investing in a 401k, you can take control of your financial destiny and build a significant nest egg over time. For example, if you start contributing $500 per month at age 30 and your employer adds $250 with an average annual return of 7%, you could have over $1 million by the time you're 65. The earlier you start, the more time your money has to grow through the power of compounding. There are several types of 401k plans to consider, each with unique features. The traditional 401k allows you to make contributions with pre-tax dollars, reducing your taxable income for the year. However, you will pay taxes on your withdrawals during retirement. A Roth 401k works differently. Contributions are made with after-tax dollars, so you pay taxes up front. The advantage of a Roth 401k is that your withdrawals in retirement, including earnings, are tax-free. This option is especially beneficial if you expect to be in a higher tax bracket when you retire. If you are self-employed, a solo 401k allows you to save for retirement while benefiting from similar tax advantages. You can contribute as both an employer and employee, maximizing your savings potential. Small businesses often use safe harbor 401k plans, which ensure that all employees receive a fair contribution from their employer, regardless of income level. Enrolling in a 401k is a straightforward process, but it requires some planning. First, check your eligibility. Many employers have specific requirements, such as a minimum period of employment, before you can enroll. Next, decide on your contribution amount. Aim to contribute enough to receive the full employer match. This is the easiest way to boost your savings. Over time, strive to save at least 15% of your income, including the employer match. Once you've determined your contribution, choose your investments. Most 401k plans offer a range of options, such as target date funds, index funds, and actively managed funds. Target date funds automatically adjust your portfolio as you approach retirement, while index funds are low-cost options that track market indices. Actively managed funds aim to outperform the market, but often come with higher fees. Finally, automate your contributions to ensure consistency. Automation also allows you to benefit from dollar cost averaging, which helps reduce the impact of market volatility. Maximizing your 401k involves several strategies. Always contribute enough to get the full employer match. This is non-negotiable. Additionally, increase your contributions over time, especially when you receive a raise. Even a small increase of 1 to 2% can significantly boost your savings over the years. Avoid early withdrawals from your 401k accounts, as these can result in hefty penalties and taxes, jeopardizing your retirement goals. Regularly review and rebalance your portfolio to ensure it aligns with your financial objectives and risk tolerance. Most plans allow automatic rebalancing, making this process hassle-free. Keep track of contribution limits, which are updated annually by the IRS. For 2024, the limit is $22,500, with an additional $7,500 catch-up contribution for those aged 50 and older. If you can afford to, aim to maximize your contributions to take full advantage of the tax benefits and compound growth. Avoiding common mistakes is equally important. One of the biggest errors is not starting early. Time is your greatest ally when it comes to retirement savings, as it allows your investments to grow exponentially through compounding. High fees can also erode your returns over time, so opt for low-cost index funds whenever possible. While the 401k is a powerful tool, it should not be your only savings vehicle. Consider supplementing it with individual retirement accounts, IRAs, health savings accounts, HSAs, and taxable investment accounts to diversify your portfolio. Keep your beneficiary information up to date, especially after major life events like marriage or the birth of a child. Finally, plan for taxes in retirement. Understanding the tax implications of your withdrawals can help you optimize your income and avoid unpleasant surprises. For those looking to take their retirement planning to the next level, there are advanced strategies to consider. The Mega Backdoor Roth, for instance, allows you to make after-tax contributions beyond the standard limits and convert them into a Roth account if your plan permits it. Employer stock options, while potentially lucrative, require careful management to avoid overexposure to a single stock. If you change jobs, consider rolling over your 401k into an individual retirement account, IRA, or your new employer's plan to avoid penalties and keep your investments growing. For those aged 50 and older, catch-up contributions provide an excellent opportunity to boost savings in the final stretch before retirement. One critical yet often overlooked factor in 401k planning is understanding the impact of inflation on your retirement savings. Over time, the purchasing power of your money decreases as the cost of goods and services rises. Even a modest annual inflation rate of 2 to 3% can significantly erode the value of your savings over decades. To mitigate this, ensure your investment portfolio includes assets that historically outpace inflation, such as equities. Regularly revisiting your contribution levels and increasing them to keep up with inflation is also essential. By taking inflation into account, you can better plan for a retirement that maintains your desired standard of living. In conclusion, a 401k is one of the most powerful tools available for building wealth and achieving financial independence in retirement. By starting early, contributing consistently, and making informed investment choices, you can secure a comfortable future. Remember, the key to success is taking action now. Don't wait for the perfect moment to start saving. Your future self will thank you.